Like the income statement, the cash flow statement also shows a firm's economic activity over a given period of time. But the cash flow statement involves the process of converting this economic activity from an accrual basis of accounting to a cash basis by adjusting net income for items that do not affect cash flows to arrive at net cash flow for the period. Whether you're a financial analyst, an entrepreneur, a creditor, or a shareholder, ultimately, a company's ability to generate cash will determine whether or not it's successful. There are many variables and accounting tricks that can be used to influence earnings. So it's actually possible to see earnings increase and cash flow decrease in the same period. And that's what makes understanding the language of accounting and the financial statements absolutely critical. All right, I'll step down from my soapbox and we can continue with the exercise. Starting with row 76, we're going to link to the income statement above. Select the projected period by using Shift and the arrow key. Press Ctrl R. Next, we move on to adding back non-cash items, which in this model include depreciation and amortization. Depreciation will be calculated on the property, plant, and equipment schedule, so we'll be coming back to fill in this value. And amortization in this model has a value of 0. Next, we have changes in working capital. A simple way to think about this is to consider that as an asset increases, it consumes cash, and as a liability increases, it provides cash. Take accounts receivable, for example. A company can book revenue when it invoices a client, but if the invoice states that the client doesn't have to pay for a certain amount of time, then that revenue will have an impact on net income, even though no cash payment has been realized. So to calculate the impact that accounts receivable has on your net cash flow for the period, we will take the accounts receivable balance from the previous period and subtract the accounts receivable balance in the current period. It follows that as accounts receivable grows, we show a cash outflow. Next, we have inventory, which is also an asset. So again, as this value grows, it will consume cash. And since inventory is conveniently located just beneath accounts receivable, we can use Ctrl D to paste the formula down. And now for both accounts receivable and inventory, we have the previous period minus the current period. And if you need some context to think about why inventory increasing consumes cash, think about using cash to purchase raw materials that are not sold in the same period. Moving on to accounts payable, now we have a liability instead of an asset, so we will do the opposite. Scroll up to the balance sheet and select accounts payable in the current period, and then subtract accounts payable in the previous period. Now in row 87, we need to input the formula for net cash provided by operating activities. So let's use equals sum, and start by selecting net income. Next, include non-cash items, and finally changes in working capital. And notice that in between arrays, I've included commas, which permits using the equals sum function to sum separate arrays. Press Enter, then we will select everything in rows 83 to 87, as well as the projected period, and press Ctrl R. And now we can move on to cash flow from investing activities. Capital expenditures will be calculated on the property, plant, and equipment schedule. So for the time being, we'll just set net cash used in investing activities equal to capital expenditures. Next, we will move on to cash flow from financing activities. And both the revolving credit facility and long-term debt will be calculated on our debt schedules. So for now, input the formula for the total below. Next, in row 98, we'll input the formula for net cash flow, which is equivalent to net cash provided by operating activities, investing activities, and financing activities. Next, we have the beginning cash balance, which is the cash balance at the beginning of the year. And if you think about a balance sheet being dated December 31st, then we can assume that the cash balance at 12/31 for the previous year is the same or close to the cash balance on January 1st of the current year. So we will select the cash balance in the previous year, press enter. And finally, to calculate our ending cash balance, we'll just take the sum of net cash flow and the beginning cash balance. As a last step, select all three rows and paste across the projected period with Ctrl R. And now that we have our ending cash balance, we can revisit the first purple shaded item on the balance sheet. So let's scroll above to cash and link this to the ending cash balance on the cash flow statement. Press enter, select the projected period, and press Ctrl R. And next use Alt-HH-N to remove the background color. And now, with the exception of the variables that we will calculate on the supporting schedules, we have projected all three financial statements. So let's move on to the next step and get started with the debt schedule. Having projected the three principal financial statements, we can move on to the supporting schedules. But before we do, let's think about what's accomplished with the supporting schedules. Their purpose is to provide an organized template for projecting components of the financial statements that we've highlighted purple. And by keeping these calculations off of the financial statements, the model appears cleaner. Now, the number of variables required to calculate items presently highlighted purple can increase substantially with the complexity of the model. This model limits these variables, but it's a great starting point that we expand on further in the series. So let's get back to the debt schedule. The first objective of the debt schedule is to calculate the required line of credit, sometimes called a revolver, that will finance any shortfall in cash. This model will incorporate a classic credit line sweep, which means that the line of credit is drawn when there is a deficit in cash and paid down when there is a surplus. First, let's link the historical line of credit balances from the balance sheet. Highlight the adjacent cell and press Ctrl R. Now, moving on to the first projected period. We will start by linking to the cash balance at the beginning of the year. Again, if you think about balance sheets being dated December 31st, then it's safe to assume that cash on January 1st is nearly equivalent. Now, before we move on, let's think about our objective. We're trying to evaluate whether or not the company has enough cash to continue operations. And if it doesn't, we're going to borrow money to finance the operations moving forward. And if it does have enough cash, we'll repay any outstanding balances. So what we're doing is taking the cash we started with and summing it with the cash generated in the current period. So we will look to the cash flow statement and first sum cash flow from operations and cash flow from financing activities. Next, we need to include cash provided by or used in financing activities. But we have to be careful to only include cash flows from financing activities before the revolver. Including the line of credit in this sum wouldn't make any sense, because we're attempting to calculate the cash shortfall or surplus generated in this period and whether or not there is a need to draw down on the line of credit. So we only select the cash impact from long-term debt. And if there were any other items listed under cash flow from financing activities, you would select those as well. And just be certain that revolving credit facility was left unselected. So press enter. And next we can decide if we want to include a minimum cash balance. It's wise to always keep a certain amount of cash on hand and to manage your business accordingly. This can help manage unexpected fluctuations in working capital, unpredictable sales, and surviving disasters in general. In this example, let's use a minimum cash balance of $2 million. So to arrive at total cash available or required from the line of credit, we will sum the cash available and then subtract the minimum cash balance. So this tells us that in the first period, we have $2.3 million available. So what we need to do in row 113 is write a formula that will use the surplus in row 112 to pay down any outstanding balance in the previous period. Or if the value in row 112 is negative, automatically increase the amount borrowed from the line of credit to manage the cash shortfall. To do that, we will use the equal max function. This function returns the largest value in a set of values. First input is 0, which makes certain that the value returned will never be less than 0. And then for the second value, we will take the line of credit balance from the previous period and subtract total cash available or required in the current period. In this way, if cash is available, it will reduce the line of credit balance. If the amount of cash available is greater than the remaining line of credit balance, the formula will return 0, because the line of credit balance cannot be negative. And if cash is required, the line of credit balance will increase. As a final step, select rows 108 to 113 and the projected period and press Ctrl R. As before, the first step is to link to historical long-term debt and current portions of long-term debt, both of which are on the balance sheet. Next, we'll link to current portions of long-term debt. Select both rows and the adjacent cells and press Ctrl R. Now the current portion of long-term debt shows the amount of debt the company is paying down every year. And to be consistent, we'll use this same sum across the projected period. The calculation for long-term debt net of current maturities is the value of long-term debt in the previous period minus the amount paid down in the current period. The last step is to calculate interest expense. To do that, we'll make two simple assumptions and say that the company pays 8% interest on long-term debt and 5% interest on its line of credit. Now, even though it's slightly out of order, let's start with the calculation for interest expense on the line of credit. Calculating interest expense in an annual model requires taking an average of the balance at the beginning of the year, or end of the previous year as we've discussed, and the current year, and then multiplying that average by the interest rate. So for the line of credit, we're going to take the average from the previous period and the current period, and then multiply by the interest rate on the line of credit. I thought that would be a little bit easier to visualize, because the calculation for interest expense on long-term debt requires that we take the average of the sum of long-term debt and the current portion of long-term debt in both periods. So while we're doing precisely the same thing as before, the formula just looks a little bit more involved. Next, multiply by your interest rate for long-term debt and press Enter. And we can paste these values across the projected period. As a final step in row 128, we'll sum rows 125 and 126 to arrive at total interest expense. With the debt schedule projected, we can now link to the corresponding purple highlighted components of the financial statements above. So let's start with total interest expense on the income statement. Now, for reasons that will be explained in a video that follows, we need to take one additional step before linking interest expense. So first we'll go to File, next Options, and under Excel Options select Formulas. And we need to make sure that Enable Iterative Calculation is turned on. And here we can see that it is, so press OK. And we can link interest expense on the income statement to interest expense on our debt schedule below. And press Alt-HHN to remove background color. Next, on the balance sheet, we can link to line of credit, and current maturities of long-term debt. Then we'll paste these values across the projected period, and again use Alt-HHN to remove the background color. Next on the balance sheet is long-term debt. Again, paste the value across with Control R and use Alt HH in. Now on the cash flow statement, we're going to be showing the cash impact. So we won't just be linking to line of credit in the current period. What we want to show is whether or not we're paying down the line of credit or adding to the line of credit. Here we can see that in the previous period, we had roughly $1.4 million outstanding. And in the current period, we have a value of 0, which means that the company had a cash outflow of roughly $1.4 million. So we'll take the current period and subtract the previous period. And we want to do the same thing for long-term debt. By taking the current period and subtracting the previous period, we show that the company made a principal payment of $500,000. Again, use Alt HH in to remove the background shading. And with that last step, we're done with the debt schedule. And we can move on to the last step, which is the property, plant, and equipment schedule. With this schedule, you're calculating the value of the company's property, plant, and equipment. This is accomplished by taking the balance of PP&E at the beginning of the year, adding capital expenditures, and subtracting depreciation. It might help to think of capital expenditures as purchases of new equipment, which would increase the value of PP&E, and depreciation as the value that the equipment you have purchased loses over time. So let's start with our beginning PP&E balance for the first projected period. This will pull from the balance sheet. And recall that the balance at the beginning of the year is the same as the balance at the end of the previous year. Let's skip over capital expenditures momentarily and start by projecting depreciation, which we will do as a percentage of revenue. There are more detailed approaches, but this provides a good introduction. So first, calculate depreciation as a percentage of revenue for the 2 historical periods. We can do this with the values found on our income statement. So first we'll select depreciation in B31 and divide by revenue in cell B7. Press enter, highlight the adjacent cell, and press Ctrl R. For the projected period, we will then use the average of these 2 figures. So remember to press F4 to fix cell references, close paren, and paste the formula across the projected period with Ctrl R. It follows that to calculate depreciation, we will take the product of revenue and this percentage. So link to revenue on the income statement, and then multiply by our projected value for depreciation as a percentage of revenue. And then paste this formula across the projected period. So now that we have depreciation, let's revisit capital expenditures. We're going to make a simple assumption for capital expenditures, that capital expenditures will outpace depreciation for the projected period. It makes sense that the asset base would grow as the size of the company grows. So with that in mind, let's assume CapEx of $3.5 million in the first projected year. And then let's increase capital expenditures by $500,000 in each projected period. Next, let's go to row 138 to calculate our PP&E balance for the first projected period. As stated previously, this will be equal to the beginning balance plus capital expenditures less depreciation. Select the projected period and press Ctrl R. Now the only thing remaining is the beginning balance for projected periods 2, 3, 4, and 5. As before, the beginning balance in the current period will be equal to the ending balance in the previous period. So as the last step for the PP&E schedule, let's paste our beginning balance across the projected period. And with the PP&E schedule projected, we can now link to the few remaining purple shaded items above. So let's start with our income statement. Now for our EBITDA calculation at the bottom of the income statement, we're going to link to depreciation in the supporting schedule below. Select the projected period, press Ctrl R, and then Alt HH, and the same matching gray background. Next, we'll link to PP&E on the balance sheet. So here we want our ending balance for the period. Press Enter. Select the projected period, press Ctrl-R, and Alt-HH-N to remove the background color. And next we'll move on to the cash flow statement. Recall that we're adding back depreciation. Because it is a non-cash item, Alt-HH-N to remove background, and subtracting capital expenditures because it is a cash outflow, so be sure to include a negative sign. So notice in our PP&E schedule, we have capital expenditures as a positive value. But when we include it on the cash flow statement, we are including it as a negative value because it is a cash outflow. And once more, use Alt-HH-N to remove the background shading. And with that final missing line item, we've completed the property, plant, and equipment schedule, which means that we've completed the model. I can only imagine how crazy excited you must be. But try to contain yourself for just a moment longer. I want to spend a minute or two on this last tab, pointing out that what you've created is a fully flowing dynamic model. To demonstrate this last point, let's go through a quick exercise. Go to the last projected year in your model, press Ctrl spacebar, then Ctrl C. Move over to column J and press Alt ESV for values and Alt EST for formats. Now we have a static representation of our model in the final projected year, which we can compare against the final projected year of our fully flowing three-statement model. For example, if you were to change revenue growth from 10% to 5% year over year, it might not surprise you much to see that revenue is lower, but you will also see that cash, accounts receivable, and inventory display much lower values as well. Prepaid expenses, however, is the same. And recall that that is because we straight-lined the value across the projected period. And it's equally important to know which components of your model will respond to input changes and which will not. Recall, for example, that capital expenditures were included as inputs in the PP&E schedule below. But does it really make sense that a company growing at 10% year over year would require the same capital expenditures as a company that grows at 5% year over year? So if instead we were to change this $500,000 per year increase to $250,000 per year, now we can go back and look at our balance sheet to see how this impacted the cash balance. Recall that prior to this change, we had a cash balance of $8.5 million. Then we lowered our revenue expectations to 5% year over year, and we had a cash balance of $5.8 million. And now by reducing the growth in capital expenditures by $250,000 in each year, we're back up to a cash balance of $8.3 million in the final projected year. What I would encourage you to do is manipulate all of these inputs and attempt to predict the impact it will have on your model. For example, if we paste our balance sheet assumptions as inputs using Ctrl-C and Alt-ESV for values, well, what do you think would happen to your cash balances if AR days grew slightly in each period? And we could ask the same thing for inventory days and accounts payable days. And you might have noticed that those were not insignificant swings in cash balances when we made those changes, even though the change to the assumptions may have appeared small. And actually, these three inputs grouped together make up what is known as the company's cash conversion cycle, which is the equivalent of AR days plus inventory days minus AP days. Or, using more conventional vocabulary, days sales outstanding plus days inventory outstanding minus days payable outstanding. The outcome is a metric that expresses in a number of days the amount of time it takes a company to convert the inputs required to make a sale to a customer into cash. There are many different scenarios we could evaluate. and I would encourage you to spend some time exploring this template, changing the drivers of the model, and trying to anticipate what the outcome will be. It's a terrific exercise and learning opportunity. As my final comment, you may have noticed that here all of the inputs no longer have the pale yellow shading background. Often when a model is complete and ready to be shared with others, it's not uncommon to remove the yellow background for a cleaner look. If you like, you can also remove the grid lines by going to File, Options, then underneath Excel Options, select Advanced, and finally scroll down until you see Display Options for this worksheet, and select Show Grid Lines, and OK. And there you have it. If this is the first time you've gone through the exercise, you've just built your first fully integrated financial statement model. That's all for now. Thanks for watching, and I hope it was helpful.